Everyone, thank you for joining us. My name's Doug Jones. I'm a partner in our energy and Husch Blackwell's Energy and Natural Resources group, and I focus on tax. I counsel businesses on complex tax structures and assist developers and tax credit buyers with tax credit issues, including with respect to credit transfers, which is our today's topic. Welcome to today's webinar. Before we begin, I would like to cover a few housekeeping items. At the top of your audience console, there are multiple applications for your use during the program today. If you have any questions during the webinar, please submit via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed or if we run out of time, it will be answered later via email. A PDF of the presentation is available in the Program Materials folder. Auto-generated closed captions are available for today's program. You can turn them on by clicking the CC button in the bottom right corner of the media player box. This program has been approved for legal education hours. For live attendees, report your hours by clicking on the continuing education sign-in link at the top of your screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Towards the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. That's it for the housekeeping items. Now we can get started. Joining me today are Cal Dargan and Andrew Eastman with Husch Blackwell, as well as Doug Kolker with Whipfly. I'm going to turn it over to our speakers to introduce themselves. Doug Kolker, would you like to begin?
Sure. Thanks, Doug. Good afternoon, everybody. I'm Doug Kolker, a partner at Whipfly. We're a national top 20 CPA advisory firm, and I lead our energy incentives team throughout the country.
Cal?
Good afternoon, everyone. My name is Cal Dargan. I'm a tax partner here at Husch Blackwell. I advise on the tax aspects of energy credit transfers, as well as advise on the general tax aspects of M&A transactions and other tax matters.
Andrew?
Yeah, thanks, Doug. My name is Andrew Eastman. I'm a partner here at Husch Blackwell. I sit in our energy and natural resources group. Most of my work is to be outside general counsel to renewable energy developers, specifically renewable natural gas developers. And so in that context, a lot of my practice touches on renewable energy tax credits and direct transfer deals.
Thank you very much. All right, so with that, we can dig in. So to start, we're talking about tax credit transfers today, and sort of here's the high-level elevator pitch for them. Purchasing a transferable tax credit allows a company to satisfy tax liability for somewhere in the range of 80 to 96 cents on the dollar. Credit sellers are willing to do this as many have insufficient tax liability to fully utilize the credits. And sellers include renewable energy project companies, manufacturers of renewable energy components, and utilities. There's been a lot of activity in the credit market over the past couple of years, and we are here to talk about it. So Doug Kolker, I'll turn it over to you for the first couple slides.
Sure, great. Thanks, Doug. So, a lot of people, have heard all the negative news on these energy incentives and that they're going away, but that's not really the case. Yes, solar, wind, EV charging stations took the grunt of the tax bill, but systems like geothermal, biogas, battery storage, all of those systems are still around and good with these incentives for the foreseeable future. So we'll spend the next few minutes going over some of the tax credits that are out there and how they work and how they've been affected by the tax bill. So the first one here is the Code Section 48, or what's called the investment tax credit. You can see there's a whole list of systems there that are eligible for the credit. And this credit starts at 6% and can go as high as 50, 60% if you meet certain criteria. The key thing with this credit is that these are for projects that have started construction before or by December 31st, 24. Anything that starts after this is going to switch over to what's called Code Section 48E, which we'll get into here in just a minute. So as I mentioned, the credit itself is 6%. It can jump to 30% or a 5 times multiplier 2 different ways. First way, if the system is under a megawatt, you automatically qualify for 30%. If you are over a megawatt, then you have to meet the prevailing wage and apprenticeship requirement. So think union wages, Davis-Bacon wages. You don't have to be a union shop, but you do have to meet those types of wages. There is a website called sam.gov that you can go to, put in your county or city, and it'll give you a report of wages by trade, both benefits and wage, and you just have to make sure you're meeting both of those. The other key important thing with the prevailing wage requirement is you want to have an advisor kind of validate that for you throughout construction. Because if you, for some reason, screw up a payroll period or don't pay someone the right amount, there is a 30-day window to correct that, and you do correct it by paying the individual. So if you wait to the end of the project and find an error, it could get costly, and then there are penalties. The other thing you're going to hear us talk about on some of these is this beginning of construction. This was from an executive order that came out after the big, beautiful tax bill was passed. And there's 2 ways for beginning of construction to be met. Physical work test, which is where you have to show actual hours being worked. It's a little bit cumbersome. A lot of companies use that 5% safe harbor rule, which is meaning that you have paid 5% of the total cost of the project prior to the beginning of construction date. And then that you continue to show that the project is moving forward and completed within 4 years. So as I said, the credit is 6%, jumps to that 30% or 5 times multiplier if you meet the prevailing wage requirement. If you don't meet that prevailing wage requirement, then you're stuck at the 6%, and then these adders that can be each 10% additional amounts would be at 2%. So that's why it is so critical on that prevailing wage requirement to be met throughout construction. And the two adders listed here is the domestic content. You can get up to a 10% bonus if now it's almost 50% of the components come from the United States or manufactured in the United States. For systems like solar, that's sometimes very hard to hit with a lot of the components coming from overseas. The energy community is, if you're in an energy zone, the DOE and the IRS have a website you can go to. Look it up. If you're in a zone, you qualify. If you're not, you don't qualify. And these are former brownfield sites, coal sites that are being converted. And then there is a third adder if you're deemed to be in a low income community. However, and again, there's a website that you can go to find out if you're in that. However, it's an application process. And so it is not guaranteed that you could, even if you're in a qualifying zone, that you would be eligible for that credit. For projects starting in 26, there is a 30-day window starting, I believe, February 2nd. So basically the month of February that you go in and apply, and anybody that applies in that 30-day window is deemed to have applied at the same time. And in all likelihood, everything will get used up or allocated in that 30-day window. So the next one, which kind of ties along to the 48, is what's called the 45 production tax credit. So the 48 credit is you get a lump sum. You know, if you spend $1 million and you're in that 30%, you're looking at a $300,000 credit. On the production tax credit, you're generating based on the power you're generating, and there's different rates across the type of power. So this one's a little bit harder to obtain just because it's over the life of the system. And so you're not getting your money up front. So we see a lot more companies taking advantage of the 48. And again, this one is on beginning of construction prior to December 31st, 24. Otherwise, it switches over to 45Y. So as I mentioned, projects starting construction after that December 31st, 24 date switches over to 48E. The calculation of the credits, that 6 to 60% range is the exact same. The biggest thing here that they added is that you now have to have a zero emission greenhouse gas. So there's a little bit more, you know, when you're starting to look at biogas, geothermal systems, those can get a little harder to qualify because of that greenhouse gas emission. Same adders apply, same prevailing wage requirements apply. The only other thing to pay attention to is from the tax bill that for solar wind projects, that if you don't start if you start construction by July 4th or 5th of next year, 2026, then there is no placed in service restriction. So you could start, you know, so for the bigger projects, as long as you've started that and met that beginning of construction requirement, then you can place these in service in 27, 28, and still be eligible for the credit. If you start a system after, again, this is solar and wind, if you start the system after that July 4th date, then you have to have that system up and running and placed in service by 12/31/27 to qualify for the credit. Systems like battery storage, geothermal, those systems did not get affected, so those are still good, as you can see, till 2034. And this is, again, the same thing as that 45, it's just 45Y. This is for the technology neutral, that greenhouse gas emission. The dates and everything that I just mentioned on the 48E apply to this as well. As I mentioned, we see most of our clients try to go after the 48E versus this, but in some scenarios, this may make more sense. And then the last one that I'm going to touch on is just the 45X, which is a manufacturing tax credit. This is for, you know, producing in the United States certain components that fall into the solar, wind, inverters, battery, and mineral components. Each one of those categories has 5 or 6 subcomponents within there that if you make those, there's certain, whether it's $1, you know, or a cent per part, $1 per part, each one has a different credit amount. The key thing on this from the tax bill is that wind components after 12/31/27 are no longer going to be eligible for this. And then the other thing is the mineral components, those will get phased out a little bit earlier, so that starting after 2033, you will no longer, credit would no longer be eligible for anybody producing those parts. And the other unique thing on this is that, you know, all of these credits that I've talked about, the 48 and the 48E, they're transferable as well as eligible for a direct pay, meaning tax exempt organizations can take advantage of this and get the money directly back from the government. They don't have to look to sell these. This credit falls into that category. You can actually get a direct payment back and not have to transfer or sell these credits. So with that, I think I'm going to turn it back over, I think, to Cal. I think he's next to touch on a few other tax credits out there.
Thanks, Doug. Section 45Q provides a credit for capturing and sequestering, disposing, or utilizing qualified carbon oxide. The credit amount is determined based on a few factors, including the metric tons of carbon oxide that is captured, when the equipment was placed in service, and how the taxpayer disposes or utilizes the carbon oxide. Credit is subject to the PWA requirements, which provides a 5 times multiplier for the credit, as Doug previously discussed. Construction must begin before 2033 to be eligible for the credit. 45Q has its own recapture provisions if it's determined that the sequestration requirements were not met in a prior year. Section 45Z provides a credit for clean fuel that a taxpayer produces at a qualified facility and sells for qualifying purposes. The credit is determined based on the amount of gallons of fuel produced and sold. Qualifying fuel includes fuel for highway vehicles or aircrafts. To be eligible for the fuel credit, certain thresholds for reducing carbon emissions compared to traditional fossil fuels must be met when producing the fuel. Furthermore, a producer must be registered with the IRS. And the qualified facility where the fuel is produced cannot be eligible for credits under 45Q, 48, Section 48, or Section 45V. The PW requirements also apply to this tax credit. Finally, Section 45V provides a tax credit for hydrogen produced in a manner that results in a life cycle greenhouse gas emissions rate below a certain threshold. The credit amount depends on that emissions rate resulting from the production of hydrogen. To be eligible for the credit, the facility must begin construction before 2028 post OBBBA. The PWA requirements also apply, and the credit is eligible for direct pay for the tax-exempt investors, as Doug mentioned earlier. Finally, in lieu of the Section 45V credit, a taxpayer may elect to treat qualified property that is part of a facility as property eligible for the Section 48 credit. So you could either get Section 48 credit or 45V, but not both. In addition, a taxpayer cannot take both a 45V and 45Q credit. With that, I think I'll jump to, is it Doug? Going back to Doug, or to discuss direct pay?
Thank you. As part of the transferability and the direct pay program, you do have to pre-register these systems with the IRS if you're looking to do that. And so, on the direct pay, again, this is strictly for tax exempt organizations. We just want to make everyone aware of that. You do have to pre-register, go through an IRS portal around the time that the system's placed in service. You then get a registration number that will go on certain tax forms that even if you don't file any tax forms as a tax exempt organization, you do have to file these tax forms. It's a 990T to claim these credits. And you want to file do the pre-registration. The IRS recommends 120 days prior to your tax filing, because it could take that long to get the registration number. And then once you have the registration number, you put it on the tax forms, you put on the tax return, and then you do need a CPA firm to file these tax forms. The IRS recommends or pretty much requires you to file these electronically. Just want to make everyone aware of this. It's not that difficult of a process, but we have seen where when you're in the portal system registering, there can be issues. So again, we assist clients all day long with this. So I think we're next turning it over to, I think it's Andrew, ready to talk about the transferability and some of the issues and concerns for that.
Yep, I think these are mine. So to dig into here just a little bit more of the details on transferability and some of the rules that apply. So the code section that gave us the ability to transfer credits is 6418. It was enacted as part of the Inflation Reduction Act. There was a lot of speculation about 6418 being just taken out of the code by the OB3. That didn't happen. Obviously, wind and solar credits the termination date was pushed up rather a lot. But if you are within the window for a wind and solar credit, you can transfer it. And all the other technologies that have a less aggressive termination schedule, if credits are determined, they can continue to be transferred. So transferability is sticking around. And it allows an eligible taxpayer, which is the seller, to transfer all of an eligible credit to an unrelated taxpayer, the transferee taxpayer or buyer. So the way it works is the transfer happens when you file an election. It's called a transfer election statement with your tax return. The seller makes this election to transfer the credit. And upon such election, the transferee taxpayer is treated as the taxpayer with respect to the credit. So it's the buyer owns the credit, and they get to use it to offset their tax liability. They cannot use it to transfer to another taxpayer. There's only one transfer allowed per credit. But for all other purposes, once the transfer happens, the buyer is the taxpayer. If the eligible taxpayer is a partnership or S corporation, the entity makes the election, not the partners or the shareholders. So that can be important if you have a seller with multiple partners. Perhaps some want to transfer, some don't. You need to make the election down at the entity level, not at the partner level. And elections are made on or before the eligible taxpayer's due date, including extension for such taxpayer's original not amended return. This is kind of an important point, because if you have, for example, a project that is getting placed in service this year, this means that you have until the tax filing date for that year, which is going to be, September 15th or October 15th of 2026. So there's a delay in the market, and that is one reason why even after the effective date for the termination of the wind and solar credits, you're still going to see credits being sold for the following 18 months or so. Important to remember that there's a bit of a delay in the credit marketplace on account of just when the filing dates are. These are the eligible credits, the ones that we've already discussed. There are also alternative fuel vehicle refueling property credits. There's credits for nuclear energy, and something called a qualified advanced project energy project credit under 48 capital C, which is a sort of a credit you need to apply for example, if you're expanding a manufacturing facility in such a way that makes it more energy efficient and less carbon intensive. There can be credits for that expansion if you apply for them and get them. So these eligible credits are determined for a taxable year with respect to a single eligible credit facility or property. So one credit per solar project, or if you're looking at a 45X, for example, typically the way that it'll be sold is a year's worth of the credits that are produced as a result of the manufacturing activity will be sold to a seller. It can be divvied up, and you can do it quarter by quarter, or really however you want. The credits, once transferred, are eligible to be carried back or forward by the buyer. The seller cannot carry the credit forward and then sell it in a later year. They need to be selling it in the year it was determined / placed in service. Here's an example of just sort of what we mean by property or facility. If you're talking about a wind project, each turbine is a facility, so you'll need a whole bunch of different registration numbers for each tower in the wind project. If it's a solar project, it's just one project. I mentioned that credits can only be transferred once. So there's a lot of credit brokers in this space, and that's completely fine. But the way they do it is they just link up buyer and seller. They don't take ownership of the credit and then sell it on to another party. That would be two credit transfers, and that's not allowed. The transferee taxpayer takes the credit, so the buyer takes the credit into account in the first tax year ending with or after the taxable year of the seller. So if you're both calendar year taxpayers, the project's placed in service in 25, the buyer will take that into account in 25. And one of the nice things about this program is that if you are making estimated tax payments, once you sign your tax credit transfer agreement, most return preparers will allow you to take the position that you can factor that credit transfer that you've agreed to buy into your estimated payments going forward, even if the transfer election statement hasn't been filed yet. So you can kind of, accelerate the tax benefits that you're receiving from the credit transfer. Eligible taxpayers are basically any taxpayer. If you're a corporation, you are likely an eligible taxpayer. These tax-exempt organizations, states or political subdivisions, and these other entities that are up here are not eligible. However, they are eligible for direct pay, which Doug Kolker already talked about. A note on the consideration. Consideration for a credit transfer must be paid in cash and must be paid in the applicable tax year. So you can't have an earnout, which would mean you're paying with cash in a note. You can't have escrow arrangements, which have a contingency hanging over going from one tax year to another. That would mean you're paying in a later tax year. So these are all done for cash in the year in question. It doesn't have to be a lump sum closing. Sometimes when you sell a PTC, there is an agreement to halfway through the year say, okay, here's our production. Buyer's going to buy the credits, for the first half of the year, and then we'll do a close in the later half of the year for the remainder of the credits that were produced. One thing to note is that the timing considerations for paying the consideration that I were just discussing are separate from the ability to enter into an agreement to transfer a credit. You can enter into a credit transfer agreement before the applicable period. However, payment must wait until the applicable period. So multiple transfers of proportionate shares of up to 100% of an eligible credit are allowed. So you can sell, one seller can sell half the credit to one buyer and half to another. However, it must be a total vertical slice of the credit, meaning if you have a base credit of 30% and then a domestic content adder, you can sell half of each of those rather than as opposed to you cannot sell to one buyer just the base credit and then to another buyer just the adder that you got from your domestic content bonus. It is worth talking about recapture because it's one of the risks that must be contended with in a credit transfer. So recaptures apply to ITCs. Limited situations, they apply to 45Q. And effectively, the deal from the government is place a project in service, we'll give you a benefit. And they kind of expect you to keep operating the project for a while in order to sort of earn that benefit. So it's a 5-year period. And if the project stops producing energy, either because it suffered some kind of natural disaster or someone sold the project or they just stopped using it to produce energy and started using it to do something else, then that would be recapture. And effectively, as you go through the period, you have to recapture less and less of the credit. In the first year, it's 100%. It goes down to 20% in the 5th year. And if something happens that means the credit is no longer, or the project is no longer doing what it's supposed to be doing, producing energy, then the credit needs to be recaptured, meaning the government's going to send you a bill for that piece of the credit. Credit buyers bear this risk. So when you're going through your process of negotiating the tax credit transfer agreement, you will have reps, some warranties about this with your counterparty, and there may be some other risk mitigation products out there, such as tax insurance, which may help mitigate this risk. I will mention a new feature of the OB3 that we now have is that I mentioned the 5-year recapture period, which is the sort of traditional recapture period for the ITC. There is a special 10-year recapture period for projects where the foreign entity of concern or prohibited foreign entity rules apply. So these rules, we'll talk about these later, so I won't get into them now. But if you run afoul of these rules, you've got a 10-year period to contend with rather than a 5. I mentioned the risk mitigation strategies. While the statute does say buyer bears the risk of recapture, buyers and sellers are free to negotiate indemnities in the tax credit transfer agreements, which every single one we've ever worked on has such an indemnity. So even though the statute says buyer, you're on the hook for recapture, if you do one of these tax credit transfers, your agreement is likely going to say that seller will indemnify you for any recapture that the buyer has to bear. Then a special penalty which applies in this situation, which is worth knowing about, is the excessive credit transfer penalty. So, buyers, when they're looking at a credit, they're going to do due diligence. They're going to make sure the credit is good. It meets all the requirements. There's a cost segregation study which supports the amount of basis and therefore the amount of credit, or there are production reports which support the amount of energy produced, which is, supports the amount of the production tax credit. But if it turns out that after you do the diligence process and you enter into the agreement and you transfer the credit, that your seller sold you a credit that you thought was, $25 million, but there were some issues and really it was only $20 million. If this gets audited, the IRS is going to ask for that, that $5 million spread back plus interest and penalties. The normal penalty would be an underpayment penalty. So you thought you were offsetting $25 million of tax, but you only offset $20 million, so you underpaid by $5 million. There's a penalty associated with that. In addition to that penalty, there is also an excessive credit transfer penalty equal to 20% of that sort of the difference between the 25 and the 20. This is one reason really highlights the importance of doing good diligence, and also highlights the importance of paying really good attention to your indemnities and other risk mitigations that you have in your agreement. For example, consider financial diligence, right? Like, you're buying credit from someone and they say, yeah, I'll indemnify you if there's a problem, but if their balance sheet is insufficient to allow them to make that indemnity, then you're probably going to be thinking about something like asking for insurance to cover that make sure there's someone who can pay that indemnity should it arise. And there is I will mention a reasonable cause exception to the excessive credit transfer penalty. It basically, if you can show that you did good due diligence, if you're working with reputable professionals to help you do the deal, they will be doing this. And if you can show that that was done, then that might be enough to show the IRS that you had reasonable cause and allow them to suspend that penalty. Okay, I think on the next one, we're turning it over to Andrew.
Yeah, thanks, Doug. We've had a number of questions come in. If we've got time at the end of this presentation, as Doug mentioned, we'll get to questions. If not, we'll follow up with people by email. There are a couple questions I'd like to address now that have come in because I think they lead into what I'm about to talk about or sort of set the stage for it. One is, what's a real sort of life use case scenario? How do these deals come about? Who's selling the credit? Who's buying the credit? The answer is that the seller is typically the regarded owner for tax purposes of the project that gives rise to the credit. That's who owns the credit. That's who generates the credit. It's called the credit being determined in IRS speak, and that's who sells it. Who buys it? It's really a broad universe of who buys these credits. It's essentially anybody with the United States federal tax bill. There are some exceptions there. Individuals typically can take the credit against passive income, but not active employment income. And there are some other rules, but generally the idea is you don't have to be in the renewable energy industry or the energy industry in any way to benefit from these credits as a buyer. You really just need to have a federal tax bill. The other question that will lead us into what we're about to talk about is whether seller has any recapture risk. The idea behind recapture is that once the credit is sold and it transfers to the buyer and the buyer takes it and claims it against the tax bill, that's typically where recapture exists. That the IRS is going to look at that claim and say, you know what, for whatever reason, part of this credit is recaptured because this is sort of the thing that first puts it on the IRS's radar. And so you're really not entitled to all of that credit that you thought you were claiming. So does seller have any recapture risk in that situation? No, not really. They've passed it on to buyer, except sort of on the back end. Seller has recapture risk in the sense that seller is going to be on the hook, depending on how you negotiate and structure your transfer agreement, for a lot of indemnity related to recapture. Seller probably is sort of on the hook in a secondary way for recapture, in the sense that in a lot of transactions, seller is buying and providing a tax credit insurance policy. And so if there is a recapture event, depending on the way you've negotiated that policy ought to pay out. And when it does, there's going to be retention, essentially a deductible that seller is going to have to pay out as well. So is seller going to be subject to recapture? No, not if seller's not the one claiming the credit, but is seller going to be subject to recapture sort of on the back end through an indemnity claim or an insurance payout? In that sense, yes. So that leads us into how do you go about negotiating and structuring these deals? The different credits we've talked about so far, some come with recapture risk and some don't. The ones that come with the recapture risk, for example, an ITC, an investment tax credit, or a 45Q credit, that recapture risk is going to make them command a little bit less of a price. They're not quite as risk-free as something like a production tax credit, a PTC, that doesn't have a recapture risk. A project that's been placed in service already, the credit generated from that project is going to be transferred at a premium because there's no risk that the project is going to fail to be placed in service. A project not yet placed in service is going to carry that risk, and so there's going to be a bit of a discount applied to the purchase price there. PTCs that are generated throughout the year, if you're buying them for a year that's concluded, you know they're generated, you can diligence that year, that's a little less risky. If you're sort of buying them on a forward basis, you're prepaying for PTCs or agreeing to pay for PTCs that have not yet been generated throughout that year, there's a little bit more risk there, in the sense that what if the machine is down and the credit's not generated because the energy wasn't generated, or whatever the case might be. And so there's a little bit more risk there, and that's going to come with a bit of a purchase price discount. And typically your transfer agreement is going to build in some sort of true-up mechanism at the end. If you think that you were going to generate and sell 100 credits, and it turned out you generated and sold 98, but you accidentally got prepaid for the full 100, there's going to be a true-up at the end. Or if you've over-generated and the buyer's okay buying for the over-generated credits, the excess, there's going to be a true-up at the end where they pay you for the excess, assuming they took them. Newer technologies, a lot of these technologies are proven and established. They've been around for a long time. Solar, wind, renewable natural gas, and the other technologies we're talking about. Some of the other projects, carbon sequestration is one of these. It's a little bit newer technology. And so the more established technologies that you know are going to function as they're meant to are going to carry a credit price premium. Less established technologies, the opposite. Doug mentioned audited financials. Seller's credit risk, essentially seller's financial strength, is going to be part of negotiating the credit price as well. If you're dealing with a credit-worthy sort of household name seller, and you know they can stand behind an indemnity claim, you're not going to be too worried about making an indemnity claim. You know that they'll have the cash to back it up. If you're dealing with a seller that's not in that position, or whose financials for whatever reason give you some cause for concern, you know that you're going to carry some bit of risk that they're not going to be able to fulfill some or all of their indemnity. And so you're going to try and offset that risk by negotiating for a lower purchase price. A lot of that risk I mentioned can get mitigated by tax credit insurance. And more often than not all the time, but more often than not, seller is going to obtain and pay for tax credit insurance for the sake of buyer. It's how you sort of attract a buyer to your credit. And that's become common enough by now that buyers know to ask for it. And so more and more sellers are doing it. That does come with a cost. The seller is going to pay a premium for that policy. The seller is going to pay an underwriting fee. If there's a claim, the seller is going to pay the retention, which is essentially a deductible. And so that's going to factor into the price as well. Seller is going to say, listen, I'm buying you insurance and it's going to cost me X. And so we need to adjust for that in the purchase price. All those things sort of go into the soup of negotiating the pricing for these credits. There are some other considerations that go into negotiating these deals. These considerations, they should be sort of back in mind when first talking between the parties. They certainly ought to be addressed at the term sheet stage. And then obviously they get baked in whatever way they're agreed into the transfer agreement. One of the most material of these considerations, once you get past pricing, is indemnity. What does it cover, essentially? What triggers it? What makes it pay out? And how much is it going to be? On the buyer side, obviously, you want indemnity to cover all of your tax liability. That means if you bought a $10 credit and there's 100% recapture and you lost that whole $10, you want buyer to make you whole for that whole $10. But in the eyes of the IRS, if you claim the credit and it turns out you didn't have it, you're actually late with your tax. There's going to be interest for being late on your tax, and you want seller to cover that as well. If there's an underpayment penalty, an excessive transfer penalty, you're going to want seller to pay that as well. Sort of table stakes is you want to be made whole for the value of the lost credit plus interest on it because you essentially turned in a tax credit in lieu of paying your taxes. The IRS said you didn't actually have that tax credit, and now you're late with your taxes. Buyer's going to want that paid on an after-tax basis. What does that mean? It means when seller turns around and pays you some indemnity amount, if the IRS looks at that indemnity amount and essentially treats it as taxable income to you, the buyer, you're going to get taxed on that. So great, you got your indemnity payment and you got made whole, but now you owe a tax bill for having received that indemnity payment in the first place. And the idea behind a gross up or a quote unquote after-tax basis is that the seller is going to increase its indemnity payment to the buyer by an amount that makes buyer whole for that extra tax that buyer is going to owe on the indemnity payment it receives. There's a calculation for how to do that. But essentially when you run the tax on the tax on the tax on the tax and so forth, it comes out to something like for every dollar of indemnity to get grossed up on an after-tax basis, you get something like $1.60 of payment to come out as if you did no tax on it in the first place. Seller obviously is going to be on the opposite side of this. Seller is going to say, I'd like to indemnify you for as little as possible. Seller is going to will prefer to indemnify on a pre-tax basis, although it's tending to sort of settle into being market that indemnity is made on an after-tax basis. More often than not, there's an after-tax basis and a gross up payment to make it come out that way. Seller's going to be looking for a cap on indemnity. That's become pretty market as well. Sellers do tend to get caps on indemnity. The real question for a cap on indemnity is what's the percent and what is that percent of? Is it a percent of the face value of the credit, say $10? Or is it a percent of the purchase price for that credit, which might be $9? Seller is going to push to make it a percent of the purchase price. That's going to be a lower number. Buyer is going to push to make it a percent of the face value. That's going to be a higher number. And then what is that number? Is it 100%, either of face value or purchase price or something more? Sellers will push for 100%, if not a little bit lower. Buyers are going to say, well, goodness, if I lost that $10 tax credit, 100% is going to get me my $10 back, but it's not going to get me my interest and my penalties and fees and whatever else comes with having lost that credit. And so buyers typically will push more for like 120%, and the extra 20% is going to cover those extra costs. So we've talked through the indemnity there. The other idea behind indemnity is essentially when does it pay out? Does a recapture have to happen? Do you need to suffer a recapture as a buyer and then appeal it and then essentially get an appellate court to rule in and say that that recapture was valid? How does the indemnity work with insurance? Can you go after indemnity first, or do you have to go after insurance first and wait to see if insurance pays out and how much and then go after indemnity? Is there a guarantee involved from seller's parent? Do you have to go through indemnity before going to the guarantee? Do you have to go through indemnity and then insurance before guarantee to the guarantee, and so forth? These are all things that typically get resolved at the term sheet stage. Why? They seem like they're awfully in the weeds for the term sheet stage, but the more you can knock out the in the weeds stuff at the term sheet stage, the less brain damage you're going to incur and the less time and cost you're going to incur trying to negotiate that when you get to actually the transfer agreement. Some other considerations, one thing that's become, I wouldn't say market yet, but we probably see it in a little bit more than 50% of deals, is that sellers going to reimburse some of buyer's transaction costs. It's usually up to a limit. I've never seen a seller say, I'm going to reimburse you for 100% of whatever you might incur. Here's a blank check, good luck to you. But it's up to some limit, and the limit varies by essentially the amount of the deal. For a $10 million deal, I've seen a reimbursement from seller to buyer of, say, $30,000 to $40,000. When you get into multiple tens of millions of dollars, you get higher. The highest I've seen is probably $125,000 worth of reimbursement. Here's something to think through. Is it going to be a reimbursement of legal cost or transaction cost? If you're going to get reimbursed, let's make a number, say $100,000 of legal cost, and your legal bill is only $50,000, you're leaving $50,000 on the table. If you're going to get reimbursed $100,000 of transaction cost and your legal bill is only $50,000, so you've got $50,000 left, transaction cost can include your accountants, outside advisors, and so forth. So then you're not leaving so much money on the table. Something to think through again as you go through the term sheet stage and negotiating how this is going to shake out. Due diligence considerations. Doug hit on some of this. The buyer is going to need to make sure that seller is eligible to have the credit determined. Seller is an eligible taxpayer. You obviously want to make sure the project exists. Some third party will go and verify that for you. You should typically get an independent engineer's report. If the project was financed with a loan of any sort, the bank likely had an independent engineer go out and look at it. The placed in service dates. Placed in service is sort of a misleadingly simple phrase, and a lot of people tend to think it means COD, the commercial operations date, and it's not. Placed in service is an IRS term of art. There are 5 factors that go into deciding whether placed in service has occurred. You don't have to meet all 5. It's very much a balancing test. If you meet 3 out of 5, that might work. 4 out of 5 might work. And some of the factors are weighted more heavily than others. If you hit 3 out of 5, but the 3 you hit are the least weighted factors and you didn't hit the 2 most important, you might have some pushback from the IRS. So you're going to want to confirm when placed in service occurs. As the buyer, you typically do that through diligence. You're looking at engineers' reports, you're looking at EPC contracts, you're looking at construction contractors' reports showing when they did certain things. You're looking at when the local utility or utility commission gave the project permission to operate. You're looking at an interconnection agreement and the date the project interconnected with either a pipeline or the local electric grid or whatever it's interconnecting with to get its power to market. But you try to cover that off with reps and warranties in the transfer agreement, wherein the seller tells you, sure enough, the project was placed in service on date X. Beginning of construction is the same. You're looking at construction contracts, you're looking at work orders, you're looking at purchase orders to see when construction occurred, but you're going to try and cover that off in the transfer agreement with reps and warranties about when beginning of construction occurred that are given by the seller as well. PTC, where you're buying a credit that's generated based on an amount of energy or something that's been produced. Maybe it's not energy, maybe it's 45X and it's the components that go into an energy project. But in any event, you're looking at production reports. How much was made during this year? And you're looking at sales to unrelated parties, especially in the case of energy being made. You're looking at basically the PPA or the offtake agreement or whatever it is whereby somebody buys that energy. ITC, in this case, the value of the credit isn't based on the amount of energy generated or the amount of energy components generated. It's based on the cost of building the energy project in the first place and which of those costs are ITC eligible. How do you diligence that? It's a cost segregation report. It's somebody like Whipfleet who's going to prepare a report and who's going to go through essentially every bill there is and decide this is eligible, this is not, and the eligible things get lumped in a bucket. And then whatever your eligible basis is, whether it's 5%, 30%, 40, 50, depending on the multipliers and adders you qualify for, somebody like Whipfly is going to tell you, this is the right percent, we can substantiate it. These are the eligible costs, we can substantiate it, apply that percent to the cost, that's the value of the ITC. And that's the diligence you're looking for essentially as a buyer in an ITC deal. That's so common that the seller will have that ready for you. Some other diligence considerations. To get from the base percent up to 30%, you're going to have to meet prevailing wage and apprenticeship requirements. Doug Kolker touched on this before. Essentially during the construction and to a large part during the repair of the project, workers have got to be paid prevailing wage. Prevailing wage is set county by county and sort of trade by trade. What an electrician makes in St. Louis County is going to be different than what that exact same electrician makes in, say, Cook County, Illinois. And apprenticeship requirements. There have got to be X number of qualified apprentices on site. They've got to do X number of hours. There are some exemptions there. If you request apprentices and for whatever reason they're not available, but you essentially made a good faith attempt to get them, and you went out to a local qualified apprentice program and they said, no, we can't help you, or they didn't respond, you've got some grace there. But you'll want somebody, and again, like Whipfly, to be looking at the PWA requirements, to be looking at the wage reports, to be looking at essentially pay stubs, and make sure that the people doing the right jobs get paid what they were supposed to do, if that's a multiplier you expect to qualify for. And all of these diligence considerations are things that are sort of trust but verify. Trust but verify and get indemnified for. Verify in the sense of look at the diligence, and get indemnified for in the sense of work these things into your reps and warranties so that if there is a breach of that rep or warranty, you can make an indemnity claim. Some other diligence considerations: energy community is an adder. You got to make sure the project sits in one of the qualified energy communities. There's an easy way to do that. There's an online mapping tool. Really, you just put in the address of the project and you see if it falls within one of the correct census tracts. Domestic content is again something that you're going to rely on probably an outside CPA firm for. They do a lot of this sort of diligence to make sure that the materials of the sort that are required were produced domestically with domestic iron, steel, and so forth. Oftentimes, seller will offer up a tax opinion or a memo from a CPA firm, from a law firm that they've met this. Environmental justice allocation is another adder, and it's something that you've got to apply for, and you'll need to sort of go through the steps to complete that application process. It's less so one of the ones that you sort of just get to raise your hand and get, at least so long as you can prove it. Another diligence consideration is at-risk rules, which I'll turn back to Cal, who will handle those.
Thanks, Andrew. An important consideration for a buyer during the diligence phase is whether the at-risk rules apply. The at-risk rule applies to a buyer purchasing ITCs, and the rules say that if a seller of ITCs has financed the eligible property giving rise to the tax credits with certain non-recourse financing, there could be a material haircut to the credit. Some sellers may not even be aware of these rules prior to the sale of ITCs. The haircut will depend on the amount of financing incurred in relation to the cost basis of the property. In short, the at-risk rules were enacted because Congress was concerned about certain taxpayers claiming deductions and tax credits for property in which these taxpayers were not subject to personal liability by reason of incurring the non-recourse debt. These rules do not apply to all taxpayers generating ITCs, so it's important to conduct diligence on the ITC seller's ownership structure to confirm if these rules apply. Another consideration in the sale of Section 48 or Section 45 tax credits is whether the seller incurred private activity bonds or state and local bonds to finance a project, because these credits could also be subject to a haircut depending on the amount of financing. So again, as discussed previously on the at-risk rules, it's important for a buyer to diligence whether seller has incurred financing in Section 48 and Section 45 deals. And now I'll turn it over to Doug.
Okay, thank you. Question came in about the FIAC rules, and so we're going to talk about them here. The question was, are buyers diligencing them? The answer is not yet, but they will be soon. Because because of that lag that I talked about earlier, between when the credit gets placed in service and when the return filing date is, the credit transfer market's a bit behind, and most of the credits that are being transferred right now and being diligenced, the FIAC rules don't apply to those yet. But they will, and you can bet that buyers will diligence them thoroughly once they are applicable. So what are these rules? OB3, the FIAC rules applied to a very specific subset of the credits before OB3. Now it widely applies. And what they're trying to do is prevent the prohibited nations, which are China, North Korea, Russia, and Iran, from benefiting from these credits. So those are the countries that you need to look out for, in addition to entities controlled or influenced by these countries or citizens of these countries. Essentially, for tax years starting in 2026, prohibited foreign entities may not claim or transfer a credit. So that's rule number one. If you have a PFE, which could be an entity that is organized in China or owned by Chinese citizens, that entity cannot claim a credit, and it cannot transfer a credit. So part of the diligence is going to be looking at your seller and making sure that your seller is not a prohibited foreign entity. For projects that begin construction on or after January 1, 2026, and we're talking about projects here, so your solar project, or if you're in the 45X situation, your components that you are producing, that project or those components may not receive material assistance from PFEs, or that project or that component will lose its credit if it does. So material assistance is, you figure out if that's happening by looking at the cost of components that went into the project that came from PFEs and that came from non-PFEs. And if you have too much coming from a PFE, there are actual percentages that are listed in the code, and they go up every year. So if you're getting too much from a PFE in any one particular year, you're not eligible for a credit. So this means that not only are you as a buyer needing to diligence your seller in determining whether or not it is a PFE, you need to be looking at the supply chain that went into the project and determine and somehow get comfortable that only the acceptable amount of components came from a PFE as opposed to an unacceptable amount. Now, we could spend an entire hour talking about the FEOC rules, but we don't have time for that here. So I'm just going to sort of leave it at that for now. And I think we've got one more slide to do, which Doug is going to do, and then maybe we'll have time for a couple of questions.
Yeah, I'll just do this real quick. This slide just touches on a couple of other energy incentives that were affected by the tax bill. A lot of these are going away. I think the two biggest ones to mention are the charging stations, the refueling stations. Those need to be placed in service that by June 30th of 2026. Otherwise, you would not be eligible. And then those that are familiar with 179D, which is for building new or putting in new HVAC, LED lighting, wrap of the building, insulation, roofing, that improves the efficiency, energy efficiency of the building. That deduction, which is up to almost $6 per square foot, that goes away if you don't start construction by June 30th of 2026 next year. The rest of those are a couple of residential and EV vehicle credits that all go away this year. With that, you want to hit some of the questions real quickly?
Yeah, we got another minute. So we have one question here. Are the indemnities in these credit transfer agreements always no fault? Meaning, do you need to point to a specific breach of a specific representation in order to receive an indemnity? The answer is no. It's pretty common for there to be no fault indemnities, where if there's any reduction in the credit for whatever reason, The seller will indemnify the buyer for it. However, there are sellers out there who will, open negotiations with a no-fault indemnity. It's pretty common for the parties to settle on something that is a no-fault indemnity. Here's a question about what are you seeing commonalities which trigger an IRS audit in an ITC or PTC situation? The answer is we don't really know yet, because the audit processes, the audits are starting now. We have credit buyers who are in the compliance assurance program who are under continuous audit. So they're probably going to be amongst the first who get audited on these. They are reporting that they have received questions from their auditors. The auditors asked them if they have done any credit transfers, and that's been the extent of it so far. Now, there likely are situations that we're not aware of, where maybe the audit has gone and been processed more thoroughly, but that's kind of what we have heard at this point. The most classic thing to get audited would be the amount of basis that an ITC is claiming, particularly if there is a step-up transaction, and we're past 1 o'clock, so I don't think I have time to explain that much more. So we didn't get to all the questions, but as I said, we will be following up with email answers. Just a few closing comments here. Thank you for joining us today. We hope this was helpful. As a reminder, we have CLE hours, so click the continuing ed link for that. We have recorded this, and you will be receiving an email with the recording. And if you have time, please do us a favor, complete our short survey, so we value your feedback, and we can start putting on more webinars like this that you will find useful. This concludes our webinar. Thank you all very much.